The economic storm clouds, they are gathering faster than most people realize. And the traditional advice of just buy and hold, well, it might not be enough to save you this time. We have all seen the headlines about bank failures, sticky inflation, and the growing threat of a global recession that could rival the Great Depression. If you are terrified of losing everything you have worked for, you are not alone. But listen to me, fear is not a strategy. The wealthy do not panic when the market crashes. They simply rotate their capital into assets that survive and thrive in chaos. Today, we are going to build a fortress for your money. This is a blueprint that can withstand a depression and protect your purchasing power, even when everything else is burning. This is not about getting rich quick. It is about not getting poor slowly while the world falls apart around you. Let us start by redefining what a depression actually looks like for an investor, because it is very different from a standard recession. In a normal recession, stock prices dip, unemployment rises, and then things bounce back within a year or two. But in a depression, asset values can stay suppressed for a decade, and entire industries can be wiped out permanently. The standard 60-40 portfolio of stocks and bonds failed miserably in 2022, and it will fail again in a stagflationary depression. You need a new blueprint, one built on tangible value and essential human needs rather than speculation and hype. The first pillar of your depression-proof portfolio is cash and cash equivalents. But not for the reason you might think. Most people think cash is trash because of inflation. And in the long run, they are right. But in the short term, liquidity is oxygen. And when the credit markets freeze up, cash becomes king. During a liquidity crisis, asset prices collapse because everyone is selling and nobody is buying. If you have cash, you can buy world-class assets for pennies on the dollar while everyone else is forced to sell at the bottom. Keep 6 months of expenses in a high-yield savings account, but keep a separate war chest of dry powder ready to deploy. However, holding too much cash is dangerous because governments will inevitably print money to try and spend their way out of the crisis. This brings us to the second, and perhaps most important, pillar, which is gold and precious metals. Think about it. Gold is the only financial asset that is not simultaneously someone else's liability. If you own a stock, you are relying on the company management, and if you own a bond, you are relying on the government's solvency. But if you own physical gold, you are relying on 5,000 years of monetary history. Central banks bought more gold in the last 2 years than they have in decades, because they know the fiat system is shaking. You should aim for 5 to 10% of your portfolio in physical gold and silver, stored outside of the banking system if possible. This is your insurance policy against currency collapse and total systemic failure. But let's be real. You cannot eat gold, and it does not pay dividends. So, we need productive assets that generate cash flow. This leads us to the third pillar, which is defensive dividend stocks in essential industries. When the economy crashes, people stop buying new cars, they stop going on expensive vacations, and they cancel their luxury subscriptions. But they do not stop brushing their teeth. They do not stop buying groceries, and they do not stop using electricity. You want to own the companies that sell the things people need to survive, not the things they want to enjoy. Look for the dividend aristocrats, companies that have increased their dividends for 25 consecutive years or more. These companies have survived the dot-com bubble, the great financial crisis, and the pandemic without cutting their payouts. Focus on sectors like consumer staples, utilities, healthcare, and defense. Energy is another critical sector because energy is the master resource of the entire economy. Even in a depression, we need oil and gas to heat our homes, transport food, and power the grid. Energy stocks often perform well during inflationary periods, which provides a massive hedge against the rest of your portfolio. Now, let us talk about the asset class that has created more millionaires than any other: real estate. Real estate is tricky in a depression because if tenants lose their jobs, they cannot pay rent. However, real estate is a hard asset that cannot be printed by a central bank. The key is to avoid high-end luxury properties and commercial office space, which is currently in a death spiral. Focus on affordable residential housing and multifamily units, where people will always need to live. If you cannot afford to buy a property outright, look into real estate investment trusts or REITs that specialize in residential or medical properties. Farmland is another hidden gem that billionaires like Bill Gates have been quietly accumulating. Land that produces food will always have value because the population is growing and the supply of arable land is shrinking. You can invest in farmland through specialized REITs or crowdfunding platforms if you do not want to buy a farm yourself. But here is the psychological trap that destroys most investors during a crash. The biggest threat to your portfolio is not the market, it is your own emotions. When you see your account balance drop by 30%, the urge to sell everything and run to safety is overwhelming. But selling low is the mathematical formula for poverty. You must have a written investment policy statement that dictates exactly what you will do in a downturn before it happens. This removes the emotion from the decision-making process and forces you to stick to the plan. Now let us address the role of bonds, because the old rules, they have changed completely. Long-term government bonds were once considered the risk-free asset, but in an inflationary environment, they are certificates of confiscation. If inflation is 5% and your bond pays 4%, you are losing purchasing power every single year. Short-term treasury bills are currently safer because they are less sensitive to interest rate hikes, and they offer decent yields. But do not rely on bonds to generate real wealth. They are merely a parking spot for stability. We need to talk about the wild card in your portfolio: Bitcoin and digital assets. Bitcoin was born out of the 2008 financial crisis as an answer to reckless central banking. It is a binary bet on the future of the monetary system. If the fiat system collapses, Bitcoin could become the global reserve asset and skyrocket in value. But in a liquidity crunch, Bitcoin can also crash hard alongside tech stocks, as we have seen before. Allocate a small percentage, perhaps 1 to 5%, as asymmetric upside potential. If it goes to zero, you lose a little, but if it goes to the moon, it changes your life. Do not bet the farm on crypto, but do not ignore it completely either. Now, look at the most overlooked asset class, which is your own human capital. In a depression, unemployment can hit 20% or higher. The best hedge against unemployment is having skills that are in high demand, regardless of the economic climate. Invest in yourself by learning how to sell, how to code, or how to fix things that break. A side hustle is not just for extra cash. It is a diversification of your income stream. If your main job disappears, your side hustle keeps the lights on and the food on the table. Let us go deeper into the specific strategy of dollar cost averaging. Trying to time the bottom of a market crash? That is a fool's game that even the pros lose. Instead, commit to investing a fixed amount of money every single month, regardless of what the news says. When the market is down, your dollars buy more shares, which lowers your average cost basis. This strategy turns volatility into your friend because you are accumulating more assets when they are on sale. Think of a depression as a clearance sale for the world's best companies. If Amazon or Apple or Google dropped by 50%, would you be scared? Or would you be backing up the truck to buy more? A depression-proof portfolio is also about eliminating the leaks in your financial ship. You must pay off all high-interest consumer debt immediately. Credit card debt at 20% interest is a financial emergency that will drown you in a recession. If you lose your income, that debt will compound rapidly and destroy your credit score and your future. Get lean and cut the fat from your budget now while you still have the income to do it comfortably. Now, let us talk about geographical diversification, because putting all your money in one country is a risk. If the US dollar collapses, you want to have exposure to other currencies and other markets. International value ETFs can give you ownership of massive companies in Europe, Asia, and emerging markets. Some of these markets are trading at historically low valuations compared to the expensive U.S. market. Emerging markets are volatile, but they have massive growth potential as their middle classes expand. Just make sure you are buying broadly diversified funds, rather than picking individual stocks in countries you do not understand. Let us pivot to the concept of the barbell strategy. Imagine a barbell, where on one side you have ultra-safe assets like cash, gold, and short-term treasuries. On the other side, you have high-risk, high-reward assets like growth stocks and crypto. You avoid the middle ground of mediocre assets that offer limited upside with significant downside. This strategy protects you from ruin while still keeping you exposed to life-changing growth. You need to rebalance this portfolio annually to sell what has gone high and buy what has gone low. Rebalancing forces you to buy low and sell high automatically without letting your emotions get in the way. Let us discuss the importance of food and water security as part of your investment thesis. It sounds extreme, but in a true depression, supply chains can break down. Having a deep pantry and a way to filter water is not just prepping, it is practical insurance. It also saves you money, because you are buying food at today's prices to consume at tomorrow's inflated prices. Investing in a freezer and buying meat in bulk is a guaranteed return on investment equal to the rate of food inflation. Now, let us look at the tax implications of your portfolio. In a depression, governments become desperate for revenue, and taxes usually go up. Utilize tax-advantaged accounts like Roth IRAs and 401ks to shelter your growth from the tax man. A Roth IRA is particularly powerful because you pay taxes now on the seed and pay zero taxes later on the harvest. If tax rates double in the future, you will be incredibly grateful for that tax-free income. Let us address the mental game of holding through a crash. The news media sells fear because fear keeps you watching. They will tell you this time is different and that capitalism is ending and that the market is going to zero. Turn off the television and look at the history books instead. The stock market has recovered from every single war, pandemic, and depression in history. Betting on the end of the world is a bad bet because if you are right, money won't matter anyway. Bet on human ingenuity and resilience, because we always find a way to solve problems and create value. Let us talk about the specific allocation percentages for a starter depression-proof portfolio. Keep 20% in cash and short-term treasuries for liquidity and opportunities. Put 10% in gold and precious metals for insurance. Put 30% in defensive dividend stocks for income. Put 20% in real estate or REITs for hard asset exposure. Put 15% in international value stocks for diversification. And put 5% in speculative assets like Bitcoin for asymmetric upside. This is just a template, and you need to adjust it based on your age and risk tolerance. If you are young, you can afford to take more risk, but if you are retired, preservation is the priority. Let us consider the threat of deflation versus inflation. In a deflationary depression, cash gains value because prices fall. In an inflationary depression, cash loses value because prices rise. We are likely facing an inflationary depression or stagflation, where growth is slow, but prices keep rising. This is the worst of both worlds, and it kills the standard bond portfolio. That is why we emphasize real assets like gold, real estate, and commodities. Let us look at the role of insurance in your financial fortress. One medical emergency or lawsuit can wipe out your portfolio faster than a market crash. Make sure you have adequate health insurance, auto insurance, and liability coverage. An umbrella policy is a cheap way to add a layer of protection to your assets. Don't scrimp on insurance to save a few dollars, because the risk is ruin. Let us talk about the community aspect of surviving a depression. Your network is your net worth. Build strong relationships with friends, family, and neighbors who can help you when things get tough. Bartering skills and resources was common in the Great Depression, and it could be again. If you are the only person in your neighborhood with a generator and a garden, you become a target. But if the whole neighborhood is prepared, you become a community. Let us get back to the stock market and finding quality. Look for companies with low debt on their balance sheets. In a high-interest rate environment, debt is a killer. Zombie companies that survive only by borrowing cheap money will go bankrupt. You want companies that have fortresses for balance sheets, with more cash than debt. Look at metrics like the current ratio and the debt-to-equity ratio. Stick to the blue chips that have dominated their industries for decades. Now is not the time to bet on unprofitable tech startups with a dream and no revenue. Cash flow is the only thing that matters when credit dries up. Let us discuss the psychological benefit of automation. Set up automatic transfers from your checking account to your investment accounts on payday. If you have to manually decide to invest, you will hesitate when the news is bad. If it happens automatically, you remove the decision fatigue and the fear. You will wake up 10 years later with a substantial portfolio and wonder how it got there. Let us touch on the opportunity cost of waiting. Many people are sitting in cash right now, waiting for the crash to happen so they can buy the bottom. But the market can remain irrational longer than you can remain solvent. You might wait 3 years while the market goes up 50%, and then it crashes 20%. You are still worse off than if you had just invested from the beginning. Time in the market beats timing the market almost every single time. Start building your positions now, but keep some powder dry for the big dips. Let us summarize the mindset shift you need to make. Stop trying to maximize returns and start trying to minimize regret. The goal is not to beat the S&P 500 every year. The goal is to survive the bad years, so you are still in the game for the good years. Survival is the prerequisite for success. Let us look at the potential for government confiscation or capital controls. In extreme crises, governments may limit how much money you can move or withdraw. Having some assets outside of your home jurisdiction can be a wise move for high net worth individuals. But for most people, simply having some physical cash and gold at home is enough protection. Let us talk about the importance of flexibility. The economic landscape changes fast, and you need to be willing to adapt. If the data changes, your opinion must change. Do not be dogmatic about being a gold bug, or a crypto bro, or a stock bull. Be an agnostic investor who goes where the value and the safety are. Let us address the fear of missing out, or FOMO. During the next bubble, you will see people getting rich on stupid things. Ignore them. Stick to your boring, depression-proof strategy. The people who get rich quick usually get poor quick when the bubble bursts. Slow and steady wins the race, because slow and steady endures. Let us consider the legacy you are building. A depression-proof portfolio is not just for you. It is for your children and grandchildren. Generational wealth is built by passing down assets that survive crises. Teach your kids about money now so they do not blow the inheritance later. Financial literacy is the greatest gift you can give them. Let us wrap this up with a call to action. Do not just watch this video and nod your head. Open your brokerage account. Look at your holdings. Are you exposed to dangerous, debt-heavy companies? Are you holding too much cash or too little? Do you have any hard assets? Make the changes today while the sun is still shining. It is better to be a year too early than a day too late. The roof needs to be fixed while it is sunny, not when the hurricane hits. You have the blueprint now. It is up to you to build the fortress. Take control of your financial destiny and stop outsourcing it to hope. Hope is not a strategy, but preparation is. Go out there and secure your future. Thanks for watching. And if you want more deep dives into surviving the new economy, hit that subscribe button. See you in the next one.